The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Well, a very warm welcome to Squawk Box Europe. I'm Steve Sedgwick with Karen Cho and Juliana Tadelbaum. And UK GDP figures have hit the wires and they look way better than expected. A relief for the UK government, up 0.3% on UK GDP, up on the month-on-month. The annual figure up as high as 1.4%, beating expectations of 1.1%. Meanwhile, Denmark and its allies send troops to Greenland as crunch talks in DC fail to garner a breakthrough. And President Trump stands firm on his position that America needs the territory.
We need Greenland for national security, so we're going to see what happens. Russia's going to go in and China's going to go in. And there's not a thing that Denmark can do about it, but we can do everything about it.
Oil prices fall as President Trump signals he could lower the temperature on Iran tensions as the US and UK reportedly pull troops out of Qatar.
We're going to watch and see what the process is, but we were given a very good statement by people that are aware of what's going on.
And Richemont quarterly sales jump 11% as the Cartier owner continues to shine in the key Christmas trading period despite wider macroeconomic uncertainties.
Not sure the last time I could say this. Good morning, Karen and Juliana. These are really good numbers compared to what we expected on the UK economy. I'll do it again for you if you weren't listening properly at the headlines. Up 0.3% month on month. UK November GDP. The poll was for up 0.1. Don't forget, we've had a couple of months where it's been either stagnant or negative. The GDP output up 1.4% on a yearly basis, better than the 1.1 expected as well. Industrial output knocking the ball out of the park in November. Up 2.3% versus a Reuters poll year on year for negative 0.4. Manufacturing really coming back. Don't forget, it was Jaguar Land Rover and the disaster going on there with the cyber attack that really hit manufacturing in prior months. Up 2.1% year on year. Poll was for negative 0.3. Even services matching expectations of up 1.4%. Construction was underwhelming though. Here is the fly in the ointment, negative 1.1% as well. So by and large, these are better than expected figures. But what does Jane Foley think of these? She is head of FX strategy at Rabobank and joins us now. Jane, you've been covering these numbers for eons for us as well. What do you think of these? Good morning to you.
Good morning. Well, of course, it's a big relief, isn't it? Now, I've got to remember, of course, when we had the figure last time around a month ago, that number came in worse than expected. And so to see some relief through today's number is a relief. Now, as you say, we had those cyber attacks for Jaguar Land Rover. We've seen this boost back now, this recovery in the manufacturing sector. We had evidence of that last month as well, but this one coming in far stronger than expected. And it's quite likely that had some knock-on effect on the retail sector too, because many people would perhaps set out to buy a car a month or two ago and probably couldn't. So that is probably leading to some growth in consumption as well, which is probably quite positive. But it is a relief. It does chime with a debate that's been going on really around about the time of the budget that maybe the UK business sector particularly was in danger of perhaps talking itself into some sort of gloom, because some of those surveys were suggesting that whilst the surveys were generally gloomy about the economic projections for the UK as a whole, some of those surveys were saying that individual businesses weren't quite as gloomy as that. And that sort of chimes with that data, that some of those individual businesses now coming through and perhaps showing us stronger numbers than we had hoped for.
Jane, it's Karen jumping in, and nice to speak to you again. There was a lot of catch-up activity taking place here. I mean, the sentiment we're talking about, the bounce back after some of the budget concern, some of the activity that has been postponed around the car market, as you point out. But what comes next after a series of catch-up that you've seen in one data set? Does it follow on to December?
Well, we now know that we will have some positive growth through the quarter, so that's reassuring. I think one of the big questions is December and actually the start of the year, because if we look at GDP data, there does tend to be, for the UK specifically, there does tend to be a habit really of this data coming in stronger at the start of the year and then tapering off. We certainly had that last year, that the first quarter of 2025 was really quite resilient, and then there was disappointment through the middle of the year. So we may have some stronger data as we go into the start of the year for that. The ONS said that there isn't a seasonal problem, but many economists are a little bit wary of that. But it does set us up in a better tone. But we've got to remember, of course, we look at Q3, we look at Q2, that was pretty disappointing. And we can't ignore those business sectors. Even though we've had an upside surprise today, there are still a lot of concerns about the impact of the tax environment, for instance, on UK businesses going through. And we still have a cyclically slowing labour market too. So we can't be too optimistic, just I think a bit more relieved.
Inflation is still not back at target, but the prospect of declining economic momentum has sort of set the scene that maybe inflation will be falling more rapidly too this year, setting the ball in motion for more rate cuts from the Bank of England. Do you think that is going to be the case if we're talking about economic resilience now?
I think it will be the case. So, as I said, we have still got a cyclically slowing labour market in the UK. So it does seem quite likely that we will have more interest rate cuts from the Bank of England. Certainly, the market is expecting that maybe 2 this year. But, there is a different context for that emerging. So, for instance, if we look at the G10, the market's only confident of interest rate cuts now from the Fed, from the Bank of England and from the Norges Bank. Everybody else potentially may see an interest rate hike as the next move in the G10. So, that puts a different environment. If we look at inflation data for the G10, in many respects, that really is already starting to bottom. And it could be that the Bank of England does run into still some signs of sticky inflation. So, yes, the Bank of England is expected to carry on cutting interest rates. But, we are getting towards the end of that cycle. But, despite this fear about sticking inflation, we did have a good point made by the Bank of England's Taylor yesterday. And he said, well, look at those increase in imports that we've had in the UK and in Europe too from China. And many of those, of course, will be goods that were originally intended to go into the US. So it does bring back this issue of maybe dumping, but certainly a pressure down on prices from these cheap Chinese goods.
Jane, that's a really interesting point. We were looking closely at the Chinese export data yesterday, which the number is much stronger than many had expected. Coming back to today's GDP data, one of the big weak points that stands out to me is construction. And I don't think it'll come as a major surprise, but relative to expectations, still disappointing. November construction output down 1.1% year on year. Polls were looking for a 0.1% expansion, also a contraction on a month-on-month basis. Last week, the PMIs also showed similarly disappointing numbers in the construction space. The house building sub-index dropping to its lowest level since May 2020. How important is the house building sector, the construction sector, to the UK economy, and to what extent is that going to be a drag moving forward?
Well, in terms of the GDP, it's a relatively small input compared with services, which of course is huge, production, which perhaps isn't as big as many people think. So it's relatively small, but it is very important in terms of politics, certainly, and in terms of how the consumer feels. Now, lower interest rates will help. It will certainly help construction. It will certainly help demand also for housing, because certainly, that has been slow, particularly with the budget, particularly with that bringing up uncertainties. And I think there is a general hope there, a general bit of optimism that with the budget now over with some clarity on there, that will instill a little bit more confidence in business, a little bit more confidence in construction firms to move ahead with projects. And of course, there is some infrastructure spending potentially coming online from the government sector too. So a little bit more optimism probably at starting the end of the year. But of course, that will be tied to what the Bank of England can and cannot do in terms of interest rates.
Jane, let's move on to the currency. Sterling right now sits around 134. I'm looking back a year ago, we were under 122. So we've really traveled quite a ways over the course of the year. Obviously, a lot of that having to do with the dollar side of this trade. But what do you think of the pound here, how it's being valued, and what's going to be the key driver of the pound trade over the coming months?
I think it's fair to say that, yeah, even when you take out the dollar out of the equation, that the sterling has been really quite resilient. In fact, if we look at euro sterling, perhaps to sort of break us free from that dollar impact, what we have seen really since the budget or thereabouts, we've seen sterling outperforming the euro. Now, I think what was happening, or what has been happening since the budget, is that the market perhaps had built up some sterling shorts into that budget in November. And since then, some of those short positions have been unwound. Now, I think it's possible that that will continue, particularly on the back of today's news, because after all, today's news in terms of the GDP was the first major UK economic data release that we've had since the start of the year. So I think that will provide a little bit of direction and perhaps sort of massage at that view that perhaps things in the UK aren't as bad as we feared. So a little bit more, I think, construction for the UK on the back of that. But as I mentioned, the Bank of England is one of the very few central banks now which the market is confidently expected to carry on cutting interest rates. So that potentially limiting upside potential for the pound.
Jane, it's inevitable that the anchors around this set who live in the southeast will have a London bias, but the fact of the matter is house prices, according to Zoopla, are expected to rise this year. But there are warning signs from Foxtons and Savills today as well. Savills said the UK heightened uncertainty around delayed autumn budget had subduing effect, especially on prime residential. And Foxtons are saying sales began 2026 with a lower under-offer pipeline than previous years. It seems very clear that the north of England and Scotland are doing pretty well. London and the southeast, less so as well. How do you view the housing market and its importance for the UK economy?
It's important. It's important, obviously, in terms of confidence too. And I think you've spelled it out. I think we had a lot of statistics since the start of this year about how difficult it has been for people trying to sell a house, particularly in London. I think one survey suggested that 15% of homes that were sold in London last year were sold at a loss. And that's a difficult thing to bear. Now, I think, as you mentioned, clarity with the budget out of the way, that will help. And of course, you've got to remember that the Bank of England also managed to cut interest rates towards the end of the year as well. So again, that will help to stir up confidence. But we are under a cyclical slowdown in the labour market, that there is a lot of uncertainty about jobs. We've had, I think, a warning today, maybe yesterday, from the Mayor of London indicating the impact of AI on jobs in the capital. That's certainly going to cause some disruption, and that will come back into confidence. So whilst lower rates can help support the housing market, there are other factors, I think, which will subdue activity also.
Thank you very much for joining us to talk us through the UK economy story. Jane Foley with us, Head of FX Strategy at Rabobank. Pushing on, US President Donald Trump says he has no immediate plans to fire Federal Reserve Chair Jerome Powell. Speaking to Reuters, Trump said it was too early to say whether he has grounds to remove the chair. His comments come amid an ongoing criminal investigation by the Justice Department over testimony Powell gave to a Senate committee last June about renovations to Federal Reserve buildings. Some diverging statements coming out from Fed speakers on Powell's criminal subpoena, with Governor Stephen Miron calling international criticism from other central banks inappropriate, while Minneapolis Fed President Neil Kashkari said the US economy is best served by having an independent Federal Reserve.
Inappropriate? Yeah, I know this, we're all on the same page, but inappropriate. So let me get this right, Mr. Miron. A load of central bankers from around the world said that they value central bank independence and they back Federal Reserve central independence, one of the great institutions and bulwarks of the US economy and US broader confidence in the dollar as the world's reserve currency. So Miron, I always lose track, thinks it's inappropriate for other people to say, yeah, it's really good that you're independent.
So I think it was the collection of voices that was so interesting. The ECB name was obviously on there, and other central banks across this region, central bankers elsewhere, the other side of the world, they were concerned about a pushback against this independence. And don't forget, there are political forces at play in their own countries trying to demand lower interest rates. Low interest rates are seemingly favourable for populations. But we've all seen the experiment in Turkey. And we were talking a number of years back when Erdogan wanted lower interest rates. It was this unorthodox monetary policy was the term we were giving it. Didn't work out so well for Turkey, did it? So the independence of the central bank, all important for the direction on inflation and what that means for the long-term economic story.
Well, I think you've hit the nail on the head. Yesterday we had Jean-Claude Trichet here, or he was joining us remotely, and I asked him, has he seen anything like this before in his career, his time as a central banker? And his initial answer was no, I have never seen anything like this. And then Steve brought up Turkey, exactly that. He said Turkey is a perfect example, weak institutions, a perfect example of what can happen when the market does lose confidence.
We discussed it for years when they were talking about fairly high inflation levels and trying to cut interest rate at the time. And we were like, well, are we all missing something? Could this experiment actually work? Let's just call it unorthodox. But it didn't, did it? As time played out, it did not work for the
And as
Turkish.
much as I have enormous respect for Turkey as a country, I love it. I've spent a lot of time there professionally, as you all know, and personally. But you know, it ain't the dollar. The Turkish lira has a 20% fall. It's traumatic for the Turkish people, but you know there's a big shadow economy, so they find a way through. But this is the dollar we're talking about.
Yeah, we were talking about controls on the flow of money out of that country in reaction at one point. I mean, and do you want that to be something that is even touching the sides of the reserve currency?
According to senior policymaker Mr. Myron, it's inappropriate for people to back central bank independence.
Yeah.
I heartily disagree. So my view, not CNBC's.
Well, to the data, US wholesale prices moved up less than expected in November, while consumers kept up a heavy buying pace. The producer price index rose just to 0.2% for the month. That was below estimates, but a shade higher than October. On the consumer side, retail sales rose 0.6% for November. That was higher than expected.
Let's take a look at the market action yesterday. I think it was actually a really interesting trading session stateside because what you saw was a lot of the trades that worked in 2025 underperformed yesterday. And in contrast, a lot of the trades that lagged last year outperformed yesterday. So we're talking about tech, we're talking about financials underperforming yesterday, while staples, energy, real estate all outperformed. I think one of the key questions that's on investors' minds now is this a trend that's here to stay, or will yesterday proved to be a bit of an anomaly? We are looking at the NASDAQ ending 1% lower yesterday, leading the losses stateside. In terms of the Asian trade, it was mixed overnight after the blockbuster session in Japan, the session previously. Right now, the Nikkei 225 off by about 0.4%. The Hang Seng and the Shanghai Composite also trading a little bit weaker, while the South Korean Kospi outperforms up more than 1.5%. In terms of the European trade, yesterday the Stock 600 gained 0.2%, its third positive session in the last four, hitting a fresh all-time intraday high. The CAC 40 yesterday underperformed. This morning, though, we are looking at green across the board, keeping a close eye on Richemont shares. That's one of the key names reporting numbers this morning. Could be a big mover at the open. We'll have Charlotte joining us in just a few minutes on that story. And finally, in terms of U.S. futures, let's take a look at the Wall Street trade. We are looking at a muted start stateside. Coming up on the show, crude prices slump as President Trump appears to tone down the rhetoric around Iran. Dan will have the latest. Plus, Amazon Web Services, near a €8 billion investment in Europe, comes to life. We'll cross live to Argent in Germany. And Trump and Europe both dig in over Greenland as high-stakes talks fail to bridge the gap. We'll be joined by Aarhus University's Erasmus Brun Peterson at 8:30 London time.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick. Here's the CEO of the London Stock Exchange Group, Julia Hoggett.
There is no justification whatsoever for not doing the right thing, even if the right thing is hard to do. Which also means that if the context changes or the information changes, it is absolutely fine to also change your mind.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
Denmark's foreign minister said it's clear US President Donald Trump has a wish of conquering over Greenland, and Washington's position has not changed following talks in the US Capitol. The foreign ministers of Greenland and Denmark met with U.S. Vice President J.D. Vance and Secretary of State Marco Rubio for talks over the island, agreeing to form a working group to discuss concerns. Ahead of the meeting, Trump reiterated his desire for U.S. control of the Arctic territory, saying in a post on Truth Social that NATO would not be an effective force or deterrent. And this on the back of the Europeans talking about bulking up a force there. Now, the U.S. president dug in on his position following the talks.
I'm not going to give up options, but it's very important. Greenland is very important for the national security, including of Denmark. And the problem is, there's not a thing that Denmark can do about it if Russia or China wants to occupy Greenland. But there's everything we can do. You found that out last week with Venezuela. There's everything we can do about things such as that. Not going to happen. We're not, I can't rely on Denmark being able to fend themselves off. They were talking about they put an extra dog, and they were serious about this. They put an extra dog sled there last month. They added a second dog sled. That's not going to do the trick.
Trump, they're critical about dog sleds patrolling.
That's not what they did, is it? That's so not true, is it? They're spending millions and millions bulking up. I mean, look, I'm not saying that they could defend Greenland, but it's not a dog sled, is it?
It's the optics. It's one person with a dog sled, and that's the defence system.
Oh my God! I mean, just this whole story is just what level of nuts is this whole story? It's like my top headline: Denmark and its allies send troops to Greenland. They're sending troops to Greenland to deter the Americans from sending troops to Greenland. We're all in NATO. Yeah. It's nuts. Yeah. This story is so bonkers. The Chinese and the Russians must be absolutely laughing their socks off on this one.
Well, meantime, the response from Denmark, the foreign minister pointed the finger at the former U.S. administration for a lack of engagement in the Arctic.
We have been stepping up. We have allocated almost $15 billion within just the last couple of years to capabilities in the high north. We have been pushing among the Arctic NATO states for a bigger NATO engagement. Honestly speaking, and now I can only point fingers at the former American administration, U.S. has historically been a bit reluctant. Hopefully that will change now. There's a dialogue within the NATO framework, and we want to step up, and hopefully that could also accommodate some of the president's concern. But it's not that I'm now, saying everything is solved. It's not solved. We didn't manage, but I honestly speaking, I didn't believe that was doable. We didn't manage to change the American position. It's clear that the president has this wish of conquering over Greenland. We made it very, very clear that this is not in the interest of the kingdom.
And a quick look at the oil price and where it's currently trading. Oscillating a bit, but still actually much higher than it was a week ago. $64 for Brent, and WTI coming off 3.3%. Dan Murphy joins us with more. Dan, you've been covering obviously all the geopolitical tensions, but I think the oil price decline clearly is more about the Iran story that you've been covering rather than anything to do with Greenland.
You've got it, Steve, and what we're seeing right now is a pretty sizable decline here, so keep watch on those energy-linked stocks at the European Open. We're seeing prices tumbling around 3% to back to $60 a barrel here, the market actually snapping what has been a 5-day win streak. Here's the comments from President Trump that's part of the reason we're seeing oil prices lower right now. Listen to this.
We have been informed by very important sources on the other side, and they've said the killing has stopped and the executions won't take place. There was supposed to be a lot of executions today, and that the executions won't take place. And we're going to find out. I mean, I'll find out after this. You'll find out. But we've been told on good authority, and I hope it's true. Who knows, right? Who knows?
The president speaking earlier, and the market really interpreted that to mean that the president might be less inclined to conduct military strikes on Tehran. That, of course, also lowers the risk of a potential supply disruption as well from Iran, which is one of OPEC's largest sanctioned producers. The fear in the market, though, is that any strike could ultimately spill over into supply interruptions or even disruptions in the Strait of Hormuz. So the market has taken some of the risk premium out of the price, but of course what happens next is still really unclear at this point. Trump has publicly said that he would come to the rescue of Iranian protesters if this violent crackdown continued. We don't know exactly what that means. And of course, we were also following reports late yesterday that the US and the UK had actually begun relocating some personnel and equipment from American military bases in the Middle East, including the Al Udeid Air Base in Qatar. This is the largest American military installation in the region, one of the most important pieces of infrastructure run by the US in this part of the world. Typically, those of us in the Middle East who follow this really closely monitor those movements, because when you do see personnel moving out, perhaps it suggests that the Americans were getting ready to make some kind of action inside Iran. That of course has not eventuated at this point, but of course we are still watching this very closely as well. Of course, at the same time, we've heard threats from the Iranians saying that they could potentially also strike locations like Al Udeid, as they have done in the past, if Washington were to launch an attack here. So the market very much on edge, but we are seeing some risk premium coming out of the price. As I mentioned, all eyes now on exactly how the US decides to respond here.
Dan, very interesting as well. Of course, Iran, one of the key players in OPEC. You cover OPEC as well. Any thoughts of any OPEC reaction, which would obviously always try to regulate the market?
Well, OPEC's certainly in watch and wait mode as well here, Steve, because the production increases that they've been rolling on with through the course of last year are now in pause mode until the end of Q1. So they've already telegraphed exactly what they're going to be doing here. I spoke with Ed Bell at Emirates NBD on Access Middle East earlier today. He's also an OPEC watcher. I said, how do you think OPEC's going to respond to this? He said, they'll do absolutely nothing, at least for now. And that's because they've already told us, they've already telegraphed to this market what production is going to look like until the end of March. After March, though, well, that's a bigger question mark as well. Ed seemed to suggest that what we could see is actually more oil coming to market, OPEC deciding to increase production here and continue to push out those barrels as it fights for what he said will be a harder battle for market share through the course of 2026.